Hello learners. Welcome back to Lighthouse ERP Farm module. In the previous video, we completed Debit Note and Credit Note purchase accounting, where we learned how adjustments are made after invoice posting. Now that purchases and sales are posted, payments and receipts are recorded, adjustments are completed, the next very important control step is bank reconciliation. Today's session is all about matching our ERP records with actual bank statements, so that our bank balances remain accurate and trustworthy. What is bank reconciliation? Bank reconciliation is the process of matching ERP Bank Ledger balance with actual bank statement balance. This helps us A. To detect errors. Both the bank and the company can make mistakes. Reconciliation helps find double entries, missed entries. For example, bank charges not recorded, incorrect amounts recorded in the cash book. B. To identify unauthorized or false transactions. Reconciliation helps catch checks withdrawn without authorization, unrecorded bank withdrawals, false transfers. This makes it an important internal control. C. To update the company's cash book. Certain items appear only in the bank statement and must be recorded by the company, such as bank charges, interest received, direct deposits by customers, auto debits like IMI or utility payments. Reconciliation ensures these are added to the books. D. To explain timing differences. Some differences are normal and due to timing. For example, checks issued but not yet cleared, deposits made but not recorded by the bank until next day. Reconciliation identifies these so the accountant understands why the balances differ. E. To ensure accuracy of financial statements. If cash balance is wrong, profit will be wrong, balance sheet will be misleading, cash flow statement will not be accurate. Bank reconciliation ensures the company reports the true financial position. F. To build trust with auditors and management. Auditors check bank reconciliations because they provide evidence of internal controls, assurance that cash is properly accounted for. Management also relies on reconciled balances for decision making. Bank reconciliation ensures accuracy, detects errors, fraud, updates cash records, and keeps financial statements reliable. In short, bank reconciliation ensures that ERP and bank speak the same numbers. Why bank reconciliation is important? For beginners, remember this clearly. ERP shows accounting entries. Bank statement shows actual money movement. Timing differences are normal. Reconciliation explains those differences. Without bank reconciliation, bank balances may look incorrect. Final accounts may not be reliable. Step 1. Bank Passbook. ERP view. This screen shows bank-wise transactions recorded in ERP. Opening balance, debit and credit entries, closing balance as per ERP. Think of this as ERP's version of your bank statement. Step 2. Bank reconciliation. Listing. This screen displays list of all bank accounts, ledger balance versus bank balance, last reconciliation date. This helps identify which bank accounts require reconciliation. Step 3. Bank reconciliation. Create process. Here we select the bank account, select the period, start reconciliation for pending entries. This is where reconciliation work actually begins. Most entries match automatically or through reconciliation marking. Only differences require adjustment entries. Step 4. Bank reconciliation entry. Manual adjustment if required. Sometimes, while reconciling, we find entries that exist in the bank statement but are not yet recorded in ERP. In such cases, a bank reconciliation voucher entry can be created. On the screen, we can see voucher type and series, posting bank account, ledger details, debit or credit amount, narration and bank details. These entries are generally used for adjustments such as bank charges, interest entries, direct credits or debits by bank. After entering the details, the voucher is saved and becomes part of reconciliation. Step 5. Reconciliation entry, listing. After saving reconciliation entries, we can view them in the listing screen. Here we can see voucher number, date, ledger name, debit or credit amount, bank reference details. This listing helps accounts teams verify and track reconciliation adjustments. Step 6. Auto reconciliation, optional. Overview. Lighthouse ERP also supports auto reconciliation, where bank statement data is uploaded. System automatically matches transactions. This is useful for high-volume bank transactions. But understanding manual reconciliation first is mandatory. Informational dashboard. This dashboard provides visibility into bank interest, odd interest, bank utilization details. This screen is for monitoring and analysis only and is not part of the daily bank reconciliation process. Important points to remember. Bank reconciliation does not change original vouchers. It only matches dates and clearing status. Differences are usually due to timing. Regular reconciliation avoids year-end issues. Always reconcile before finalizing accounts. Process summary. ERP Bank Ledger shows recorded entries. Bank statement shows actual movement. Bank reconciliation matches both. Differences are identified and explained. Final bank balance becomes accurate. This completes the bank reconciliation process in Lighthouse ERP. In the next video, we'll move to an important control and validation layer in accounting accounts approvals, including purchase approvals, expense approvals, consumption postings, closing stock, inventory postings. This will help you understand how accounting entries get validated before final posting. Thank you for watching, and see you in the next session.